Hello and welcome to this Monday's weekly market briefing. We've got lots to talk about, but firstly, Israel warns it can no longer accept Hezbollah on its border. As well as that, Jerome Powell is under pressure to set out plan for US interest rate cuts. India stock exchange is also set to take over Hong Kong's place on the largest stock exchanges of the world. We've got lots to talk about in the charts also, with lots happening on the economic calendar. We'll come to that near the end, so make sure you stay around till you see that. But before we get straight into it, make sure you subscribe. But the first article obviously to talk about is Israel. Now, no longer can Israel accept the presence of Hezbollah on its border, according to Israel? And this comes as Israel's national security advisors say they will have to act if they continue to pose a threat. Now, in terms of what we've been talking about, mostly in reference to Israel, is of course the conflict ongoing within Gaza. Now, following the October the 7th massacre, where Hamas stormed the borders of Israel and massacred over 1,000 civilians, took more hostage, Israel have launched that ground campaign into the territory of Gaza. As a result, we've seen many deaths, targeting those terrorist groups within Gaza, but also having the collateral damage on the civilian populations due to the density of the area. But mostly we've been talking about Hezbollah as a kind of a militant group which had the option to kind of join the conflict. Obviously, we've seen the Houthis, a Shia militia group, also backed by Iran, sending missiles and rockets towards Israel. But the Houthis really never had the same kind of risk of escalation as we did, as Hezbollah always has when we've talked about risk of escalation in reference to this conflict, because Hezbollah boasts far more members, far more soldiers, and arguably is of greater significance to its kind of funding kind of parties, including Iran, and therefore we've kind of always talked about Hezbollah as a key instigator or kind of risk of escalation if Hezbollah do get involved, because we have heard that kind of repeated rhetoric from Hezbollah that they want to get involved, that they will, in reference to Hamas's fight against Israel. But we haven't yet seen Hezbollah get involved on a full-scale invasion into Israel. We've only seen those small-scale skirmishes on the border of Israel and Lebanon, and therefore we've been able to kind of just put this to the side and say it's more of a regional issue. However, what we're hearing now is that this could escalate into a full-scale war, which obviously poses the threat of a ultimate regional escalation, and therefore a damage to the world's oil supplies, as we've spoken about before, which could risk oil running to highs of $150 a barrel and that sort of thing. And all these sort of risks which could be become reality just as a result of Hezbollah joining the war. Now, Hezbollah is a Shia militia group backed by Iran, just like the Houthis, and has been engaging in border skirmishes with Israel for the last 2 months since the war broke out between Israel and Hamas, as I said. Whilst casualties have occurred on both sides, the skirmishes have not escalated into a war, and this has largely been achieved by diplomatic efforts by the US and others, which have been, in efforts to basically prevent further fighting. But the rhetoric has now changed, however, after Tajiki said Israel could not accept a situation in which residents of northern Israel who were evacuated at the start of the war would be afraid to return home in fear of a cross-border attack by Hezbollah. Now, in reference to what he's talking about here, those living in the north of Israel, near the Golan Heights, or just on the border of Lebanon, were kind of evacuated following Gaza's incursion into Israel's territory, with Hamas obviously massacring all the civilians near Gaza. As a result, Israel did evacuate those civilians on the northern border, as they were worried ultimately that Hezbollah has far more resources, far better trained soldiers, would send its kind of militant factions into Israel on that northern border and do the same that Hamas did, or even just engage in a full-scale invasion and therefore create that kind of conflict which could cause that collateral damage to those Israeli civilians. And as a result, we did see those evacuations take place. And now the risk is, well, the issue is now that this conflict could go on for a very long time. The one being, in the war in Gaza. And as long as that war goes on, the risk of Hezbollah getting involved is very great as well. And therefore, how does Israel deal with this situation? Do they allow their civilians to move back into that territory with the risk of them also being taken hostage? Or in fact, do they clear Hezbollah from the surrounding regions? This has been tried and attempted before to no avail, but the question is, will they try it once again? Now, this also comes after Israel's Foreign Minister Eli Cohen warned of a risk of war if UN Resolution 1701 was not enforced, which initially restricted Hezbollah activities in the south, which prevented them from operating or existing in the south of Lebanon, near the border of Israel. And over the weekend, Israeli jets have also been hitting targets, including a Hezbollah command center, with Hezbollah being a strong militia group boasting 100,000 fighters at the ready. And the war in Gaza is also continue. The war in Gaza also continues to rage following that October the 7th massacre. But the US has now vetoed a UN Security Council resolution, which was initially calling for an immediate ceasefire in the war between Gaza and Israel. And so that's very significant, of course, as this kind of adds to the world tensions. So look out for the effects of that on the charts as well. But that's all to talk about in reference to Israel. Keep your eyes on this though, as the potential of regional escalation, if Hezbollah do get involved, is high. So keep your eyes on that. Next to talk about though is Jerome Powell. Now, Jerome Powell this week must maintain policy flexibility in the face of intensive pressure. Now, the Federal Open Market Committee meets for its final two-day gathering of 2023 this week, with Powell confronting an increasingly mixed economic picture. Now, we've been talking a lot about the Federal Reserve, of course, the issues with the US inflation, but generally we've been covering it with kind of keeping up to date in terms of the situation. Now, obviously, Jerome Powell and the whole of the Federal Reserve do have their meeting and policy decisions this week, and therefore that being the last kind of decision on terms of interest rates at the end of the year is very significant indeed. It rounds off the end of the year, and we are kind of in a position now where we are seeing inflation fall within the US at quite significant levels, beating economists' expectations. And obviously, as I've mentioned, the mixed economic picture within the US is creating these kind of turbulent and very interesting times for the US economy. And therefore, Jerome Powell's kind of in a very tough position and very interesting position where he has to deal with this and kind of create a plan to deal with this. And so the question is how he will approach this. We've heard repeatedly from Jerome Powell that we need to take more time to listen and hear all the data before we can make these large decisions on what to do with interest rates next, as many people have been expecting cuts to interest rates after we've seen that cooling economic data. But overall, Jerome Powell's message has been clear. We need to see more data before we can make those decisions. So going into this last meeting of the year, it'll be so interesting to hear that rhetoric, what's clear about what the Fed wants to proceed with or not. So that's the key thing that we're listening out for. With the labour market being resilient in reference to the mixed economic picture, as well as consumer spending being solid, and there still being signs of solid growth. So it's kind of a tough thing to balance. And with the Fed being expected to hold interest rates at 5.25% to that 5.5% territory for the third time in a row. Now, the challenge for Powell is to decide when rates will have sufficiently reached a restrictive level to get inflation back on target, and then decide when rates should fall. And the thing that's also challenging Powell, I guess, is the fact that markets now believe that additional monetary tightening is not on the table at all, and are definitely not buying his warnings in relation to where kind of policy positions are at. As Jerome Powell has kept on kind of saying that rising interest rates further is not off the table, that we can't really talk about dropping interest rates anytime soon, but markets aren't seeing it this way. They're seeing those lower levels of inflation, and they're running with it. And that's why we've seen this kind of spike in US indices most recently, as people just see their money flow into these assets in the hopes that interest rates are cut sooner than expected. As think back to September of this year, we were expecting interest rates to possibly even be risen further by the end of this year, in this December meeting. So, it's no surprise that, the market's now pricing in those lower interest rates very early on. With this seeing financial conditions loosen and affecting the Fed's efforts to dampen demand, which are now being jeopardized. But the conference on Wednesday will give him the opportunity to reiterate his view that it is premature to declare a policy pivot is underway, despite inflation moderating. With him also being set to issue a set of economic projections, obviously, with that obviously also including inflation, unemployment, and growth. So this is going to be key to listen out for. Once again, we'll return back to it on the economic calendar near the end, so make sure you stay around so you see that. But that's all to talk about in reference to this article. Keep your eyes on it indeed. Next to talk about, though, is India's stock exchange. Now, the value of the National Stock Exchange of India is poised to take Hong Kong's spot among the largest trading venues. And this is according to some showing an attest to investors' optimism about India's prospects, with the total market cap of the NSE being $3.7 trillion in October, compared with the stock exchange of Hong Kong's being at $3.9 trillion. Meanwhile, share prices in Hong Kong have fallen as the China's economy does cool. And this is what we've been talking about a lot, is the issues within China's economy, as we have been seeing that slowdown. And this is obviously largely as a result of that weakening foreign demand, which largely drives the Chinese economy, but also that weakening property market within China, which obviously a lot of the economy relies on, and is a lot of what general individuals are invested in, and therefore the decline in that and the issues to do with that does affect consumer confidence. Now, India's Nifty 50 index of large companies have risen 8.1% in November, hitting record highs, and Hong Kong's Seng index fell 6.7%, however, in the same period, being dragged lower by a liquidity crisis in the property sector and low investor and consumer confidence, which is going back to what we were just talking about. Strong consumption in India is attracting investors with increasing spending on property, luxury and higher end goods by affluent Indians, as well as increased government infrastructure spending. And so this is all adding to a very bright image for investors in reference to India. And India is the world's fastest growing big economy this year, set to expand by 6.3% this year, compared with 5% for China, according to the IMF. India's rising share prices have been driven by more domestic than foreign money flows for most this year, but foreigners are now net buyers of Indian equities after being net sellers in September and October. So it's very interesting times for India. Of course, many people are calling the Indian economy, the new Chinese economy. So keep your eyes on the things that are going on over there. But yeah, very interesting situation shaping up for investment. That's all to talk about on the articles, though. Next to talk about, of course, is the charts, where we do have quite a few things going into this week. Now, I think the best place to start, as we always do, is on US indices. Now, as you can see here on the US 30, we are seemingly ranging. And now, this was something that we were talking about last week, is how the US 30 does generally see these kind of periods of bullish movement or bearish movement, and then these short periods of consolidation, where prices range and kind of, price and orders are kind of accumulated. And that's what we could be seeing here. As if we just go back, to the start of November, this is where we really saw the beginning of this bullish move to the upside. And this is the bullish move, which actually goes back to that second article that we spoke about with, the more dovish expectations from the Federal Reserve driving asset prices in the US up, as you can see here, a massive push to the upside following, those lower levels of inflation data driving expectations of lower interest rates. But as we've seen this move to the upside, if you can just look here, we do have these short periods of consolidation where prices do range shortly, and even these periods where price does, slow in its momentum. So it's unsurprising that we are seeing this consolidation. Now, what's interesting about this consolidation, however, is because we do have that final Federal Reserve meeting this week, the question is how this will affect the charts. Now, obviously, if we're hearing more of that dovish rhetoric from Jerome Powell, we may see, a break out of this range to the upside. Or if we see more of that hawkish rhetoric, we could see a move to the sell side, as ultimately we could be in an overpriced territory here. As we kind of spoke about on that second article, we're talking about how Jerome Powell is kind of in this difficult situation where the market is like very, very dovish at the moment. They expect those lower interest rates, but the Federal Reserve seems adamant that we need to wait for more of this data to come out. So quite possibly we're going to hear a reiteration of that hawkish kind of position, and therefore a significant sell-off from these areas. I've marked out the Fibonacci retracement tool from last week, but obviously because we're in a range, it's unlikely that's going to have much effect. So keep your eyes on US indices. Next to talk about though is the dollar, of course. Now the dollar has kind of spiked once again to tap this previous area of resistance, but not too much going on with the dollar, apart from the fact that it does seem like it's in this moment of reversal, as this most recent low did not break structure. It did not break below the most recent higher low. Therefore, we're kind of getting that overall message that price is on the upswing. So keep your eyes on that. Obviously, I drew out this Fibonacci retracement tool, and it does seem that price reacted with that 50% Fibonacci mark. But what will be interesting to see is, with the Fed's meeting this week, how will price react? So keep your eyes on that. Next to talk about though is euro dollar, which has reached the position which I spoke about recently in reference to if there was anywhere for price to move up and away from, it would be the 78.60 area. And this was after we saw this continuous decline in price by euro USD, with it continually breaking below all these significant kind of Fibonacci retracement areas, breaking below that 38.20, breaking below that 50%, breaking below that 61.80, and generally we do say that the 78.60 does have the greatest potential for upside. And what will be interesting to see is how price does react, as it is reaching this significant area of liquidity and support, of course. However, we do have such significant Eurozone ECB data coming out this week, as well as such significant US data coming out this week. If we just list it off the top of the head, we've got like Eurozone sentiment, economic sentiment figures, US inflation figures, Fed press conference, ECB interest rate decision press conference. So it'll be a very, very interesting week on the charts for Euro USD. So how price will react from this area, how price will go move throughout this very intense week, it'll be interesting to see. So keep your eyes out for that. Quick to brush over, we do have pound yen and USD JPY, which is in a very odd position, of course, after we did have that flash crash last week, and now we've kind of responded in, you know, a way where prices tap that liquidity and has taken a move to the upside, and this is repeated also in the USD JPY. So we can wait and see how price kind of calms down and forms going into this week. Next to talk about though is Bitcoin, which does hold after tapping this area of resistance once again on the charts. Obviously it did break above those most recent highs, but only just, and did not kind of stay up and above there for long. It did return below that level. We do still have this 3820 level marked out as an area which price could retrace to and then move from. So it'll be interesting to see whether price does make its way down there, or in fact it does hold out around this area of consolidation. So keep your eyes on that. Last to talk about on the charts though is gold, which is still sitting above that $2,000 mark at the moment. However, did kind of come down very close to that $2,000 mark and did tap that $2,000 mark. So it'd be interesting to see how gold moves throughout this week. As you know, last week we did go up and even reach, well, no, on the Sunday, sorry, and Monday, we did see price reach all the way up until highs not seen ever before. So, you know, what's happening with gold, it'll be interesting to see, so keep your eyes on gold. But that's all to talk about in reference to the charts. Next to talk about, and lastly to talk about, of course, is the economic calendar. So what data is coming out this week? Now, the first bit of data that we do have coming up this week will be UK unemployment and employment data, as well as the UK's GDP figure. So listen out for that. As well as that, we will be getting Eurozone economic sentiment index figure being released, along with the German index figure also being released. As well as that, we're getting the US inflation figure, so that's very, very important to listen out for, as well as their producer price inflation figure. Along with that, we'll also obviously have that Fed press conference following it, so listen out for that. As well as that, we are getting Aussie GDP growth rate figure, New Zealand growth rate figure being released, as well as Aussie unemployment data also being released. As well as that, we're also getting the Bank of England's interest rate decision this week, along with the ECB's interest rate decision and their press conference, of course. And finally, we will be getting US retail sales data, along with German manufacturing figure. So, you know, lots of data coming out this week. Sorry for such a haphazard video, but I think we've covered a lot on the articles, lots on the charts, and lots on the economic calendar. That's all from us at Wildwood Capital. Have a great trading week, and I'll see you tomorrow. See you later. Bye.